Hey, Jordan from Precondo here. Today we are going to talk about the housing market in the GTA. Things are not looking great. Now I have to admit to using a little bit of clickbait in the title because the Toronto housing market actually seems to be holding up the best. Well, areas like Brampton, York, Peel, sort of the suburbs surrounding the GTA, they are essentially free falling in price. All right, so first up here, we have the median sales price for detached. So important to note, this is the median sales price better than the average. And you can kind of see the peak here in February, and then it just cliffs for all markets. But you can see that the Toronto market, so the 416 proper, they're holding up the best. Durham is doing the worst. So the numbers for the February highs, so February of this year versus May of this year, so May to date, Durham's down 23.2% on a median price basis. Halton's down 14.9%, Peel down 14.5%, Toronto down 9.5%, and York region down 13.1%. Now, if we flip over to the condo segment, it's not doing so hot either, but it's certainly doing a lot better than the detached segment in all of the markets that we're talking about today. Now, here are the numbers for condos. So Halton, you're down 8%, Peel 8.4%, Toronto's only down just under 6%, and York 6.4%. So condos are holding up better as we anticipated. They appreciated the least through COVID, and so they're also the most affordable segment of the market. So they're probably the least affected by rate hikes. Now let's go through some carnage. I know why you guys are here. You want to see some listings selling for less. So let's go through some carnage here. Not funny to laugh at people's misery. What I'm about to show you is actually kind of unfortunate. These are most likely failed closings, meaning that somebody purchased this home and they weren't able to close on it because the appraisal fell short. And when that happens, the seller can actually go back and sue them for the difference, sue them for the damages in their original sale price versus their new sale price, as well as keeping their deposit. So not only do you not get the home, but you can be sued for the difference in price. So here we have one in Orangeville, sold for $995,000 back in March, and it resold just recently for $799,000. So a difference of almost $200,000, down 19.6% in a couple of months. Next up, we have something in Mississauga, something a little bit closer to Toronto here. This one sold for $1,836,000. And then it just resold for $1.525 million. So this one's down 16.9%. Here we have one in, I don't even know where this is. Now I gotta look where this is. Warkworth, Trent Hills. Oh, I know where this is. Okay, yeah. There you go. This property sold for $1.22 million and then resold for $900,000. So that's a 26.2% decline in price. That has to sting. If our assumption is correct, the original buyer didn't get the appraisal, couldn't close, couldn't come up with the cash, then the seller is going to recoup that deposit. So really bad position to be in for the buyer. Finally, we got an example in Scarborough here. So this one sold in February for $1.256 and then it just resold for $980,000. So almost a 22% difference in price here. Now I want to provide a little clarity, a little color to the situation because I think some people are very panicked about the fact that housing market is going down. Now, obviously, you can't live in a world where housing markets always go up and only go up. You're going to see corrections along the way, but the general trend line over the last 45 years is about 6 to 7% appreciation depending on the asset class. However, we've had markets like 1989, 2008, where you didn't see price growth. And in the case of 1989, you didn't see price growth for quite a long period of time. So it's important to remember that over a long period of time, yes, real estate does very well, but when you're looking short term, things change. But I will say that unless you purchased in February or March and your closing's coming up and you know that appraisal is going to fall short and you don't have the cash and liquidity to be able to make up the difference, unless you're in that camp, which is a very select few people that I feel for, you're going to be fine, right? If you bought a home that you plan on living in for 10 years, 15, 20 years, this short-term dynamic you shouldn't allow it to keep you up at night. And here's an example for context. This is a nice home in Ancaster that sold back in 2020, towards the end of 2020, for $1.28 million, and it just resold the other day for $1.77 million. So, it's up 27.6% in less than 2 years. So it's important to remember that, you zoom out and the picture gets a lot better. And on the note of zooming out, let's look at the last 10 years of price growth. So blue line here is the average price of a condo. Green line is the average price of a detached in York region. And then the orange line is the average price of a detached in Toronto in the 416 proper. So what I really want to point out on this chart is the fact that we saw a detached correction back in 2017. So if you remember, 2017 is the year when they announced the mortgage stress test and the NRST, so the non-resident speculation tax of 15%. As a result, we saw almost an immediate cooling in the detached markets sort of around Ontario. And also, the rate hikes of today are not that dissimilar from the mortgage stress test of 2017-2018. Sure, the mechanism is different, but the net effect of reducing buying power is very similar, right? So you saw a really strong run up in detached prices, enter the mortgage stress test to cool things off and reduce buying power, and you saw a immediate cooling in the detached housing market. Of course, we've since made up for those price losses and then some. But what's interesting to me is that condos didn't suffer that same fate. So they cooled a little bit and then they really ran. In fact, 2017 through 2018, really 2016 through 2018 were some of the best years for condo appreciation. And I think part of the reason for that is when buying power reduces, two things happen, right? When buying power is reduced, people tend to go to the most affordable option. And if you're priced out of detached, that might be a townhome or it might be a condo. The other thing that happens is more people pivot to the rental market. So a lot of buyers kind of pump the brakes, say, I'll kind of wait this out. And they go to the rental market. And that's exactly what we're seeing today. So the condo rental market in Toronto is hotter than it's been for the last 2-3 years, right? It's the hottest I've seen the rental market in some time. And a part of that is because people are moving back to the city. And the other part of that is because rates are rising. And you tend to see rental rates rise when mortgage rates rise. So something to keep in mind. And then to put this chart into context, right? If you go from April of 2012 through April of 2022, property prices have more than doubled. Whether you're looking at detached in Toronto, York, or condos in Toronto, the property prices have more than doubled. So I've annualized the return here. So, even with the correction in 2017, Toronto detached averaged 8.9% year over year, York detached averaged 9.5%, and Toronto condos averaged 8.6% over the last 10 years. And I think that's important to kind of keep a level head through this. A lot of people on Twitter are panicking. The reality is we've seen corrections before. This too shall pass. Next up, months of inventory. So thank you to Scott Ingram for sharing this chart. Months of inventory simply distills whether you are in a buyer's or a seller's market. Anything below 3 months of inventory is a seller's market. 3 to 5 is a balanced market, and 5 and up is a buyer's market. You can see here, condos the green line and freehold is the black line. This is for the 416, so Toronto proper. And you can see here, we are rapidly approaching balanced market territory. If the current trends continue, we'll probably be there in a month or two, and there should be some good buying opportunities. So something I've been telling some of my clients is kind of, put the pause on, pump the brakes, wait and see how this plays out. You'll start to see months of inventory trend back down when things are improving. There's no reason to rush into the market right now. There's probably going to be more buying opportunities over the next few months. If we've learned anything from the last 2 years, it's that FOMO can bite you. And sometimes it's better just to sit on the sidelines and wait. The exception being, of course, if you're buying pre-construction as an investment for your child to downsize into, you're not going to get lower prices by waiting because the cost of building is increasing. But if you're looking at the resale market and that's what you want to buy existing housing stock, there might be some really good buying opportunities in the near future. I think it's safe to assume we get another 50-point rate hike in June here. And that's it for this video, guys. So if you like this type of content, please like and subscribe, and I will catch you guys next video.